Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're continuing digesting some of those earnings results that would have come out over the past few weeks. And of course, today we're taking a look at the banking sector once again at a truly regional financial conglomerate, as well as an aspiring financial conglomerate at the regional level. We're talking about, of course, NCB Financial Group, as well as First Citizens Group Financial Holdings, or FCGFH. Now, both groups would have reported contrasting earnings. Let's take a look at why this would have occurred and what investors can expect in the coming months. Turning firstly to NCBFG, or NCB Financial Group, the group would have reported an earnings per share figure in TT dollar equivalent of 28 cents, which was a 22% decline from that 35 cents recorded in the prior fiscal year, which would have ended in September 2020. Now, the net results from banking and investment activities would have actually improved up around 28% from 3.36 billion TT equivalent to just around 4.3 billion TT equivalent. However, that would have contributed to an increase overall in net operating income of 11.3% from 4.78 billion to 5.3 billion. Operating expenses did climb as well, around 16% from 3.58 to $4.1 billion, resulting in profit before taxes falling around 3.5% from 1.2 to 1.7 billion. Overall, net profit attributable to equity holders of NCB Financial Group actually declined 25% from 840 to 626 million TT dollar equivalent. When we take a look at some of those major or significant contributors to net operating income on a segment basis, we can see that there were some notable changes. The net result from insurance activities in that pink segment actually declined just around 30% from 1.4 billion to just over 1 billion. There was a 5% increase in net fee and commission incomes from that, or in that yellow segment rather, from 940 to 990 million. The major contributor to net operating income, which is net interest income, of course, actually declined 7.5% from 2.3 billion TT equivalent to 2.14 billion. And there was a very significant turnaround in gains on FX and investment activities, which actually experienced a 160% increase from 387 million to just around 1 billion TT equivalent. Now, when we take a look at the valuation story for NCB, well, investors may be taking a look at these fairly elevated valuations, especially amidst or in the context of declining earnings, which has been experienced over 2 consecutive fiscal years now. And we can see that after peaking at around an earnings per share figure of 54 cents per share in fiscal 2019, NCB Financial Group hasn't really caught back on or recovered just yet, with two consecutive declines in that earnings per share figure, falling to 35 cents per share in fiscal 2020 and 28 cents per share in the most recently concluded fiscal 2021. However, the share price has remained fairly resilient, so much so that it has actually led to quite an expansion in the price to earnings ratio, or simply put, what an investor pays per $1 of earnings generated by this particular stock. And we can see that that particular price earnings ratio has expanded from around 11.4 times in fiscal 2018 to its current level of just under 30 times, which is quite inflated on a historical basis for NCBFG and certainly for the banking sector as a whole. Now, at a price of $8.01, NCB Financial Group is trading at that price earnings ratio of 29.5 times, which is well above the banking sector average of 20 times, which is on its own, again, fairly inflated by historical standards. And the stock does offer investors a dividend yield currently of 0.3% relative to the 2.4% of the banking sector average. Now, on the basis of recovering financial markets, particularly for investors playing the longer term game, but on the basis of that relatively high valuation and overlaid by economic uncertainty, Bourse is going to maintain its neutral rating on NCB Financial Group for the time being. As we take a look or turn quickly to FCGFH, or First Citizens Group Financial Holdings, that's a mouthful. The group would have generated an earnings per share figure of $2.64, which is a very tidy 10% increase from that $2.40 recorded in the prior comparable period of fiscal 2020. Again, the financial year end for the group is September. Net interest income would have actually been down 7.8% in the case of FCGFH, from 1.6 to just around $1.5 billion total net income, in contrast to the NCB Financial Group, financial holdings would have declined actually 4.2% from 2.2 billion to 2.14 billion. A very sharp decline in credit impairment losses would have contributed to an overall increase in profit after taxes of, to 667 million from $607 million for FCGFH. When we take a look at profit before tax by segment trends, there were some noticeable changes. Trustee and asset management profits would have fallen 34% from 91 to 60 million. Treasury and investment banking would have increased just around 13% from 300 to 359 million. The corporate banking segment would have increased a whopping 30% from 474 to 637 million. And there was a 30% decline in retail and corporate banking profit before taxes from 353 to 285 million. So a somewhat mixed bag overall, but generally positive profits for the First Citizens Group. Again, from an valuation perspective, investors will be shrugging their shoulders a bit. The stock price has continued to climb, leading to very lofty valuations. From a price to earnings ratio perspective, again, that price to earnings ratio would have hovered between the 12.5 to 13.5 time level over the past 3 fiscal years of fiscal 2017 to fiscal 2019. Post-COVID or during COVID and post-COVID, that ratio has actually expanded to just around 22 times. And we can see that there has been some recovery in earnings per share, but still not quite to the levels of fiscal 2019, where earnings per share was just around that $3 handle or $2.98 per share. So at that price, or its last traded price of $58 per share, First Citizens Group is trading at that PE ratio of 22 odd times, which is just slightly above an already inflated banking sector average, with a dividend yield of 2.5%, pretty much in line with that banking sector average of 2.4%. Again, keeping an eye on those elevated valuations, but bearing in mind recovering financial markets and perhaps with one eye on potential future acquisitions for the group, namely Scotia Guyana's operations. But again, overlaid with that economic uncertainty, Bourse is going to maintain its neutral rating on FCGFH for the time being. But that's it for this week's edition. For more information, give us a call at 226-8773. Email us at invest@boursefinancial.com. And you can check out our website, where all of our research is absolutely free at bourseinvestment.com. And you can, of course, catch us in today's business section of the Bigger, Better Trinidad Guardian newspaper. See you next week. This has been the Bourse Report. Stay safe and get vaccinated.